There are a few different ways to manage positions and look after your trades when you're already in them. One of them is stop loss trailing, and that is what we're going to talk about today. I'm going to show you what stop loss trailing is and how you can use it correctly to create win-win scenarios in your trading, which ultimately will help you to increase your total profits. So let's get straight to it. So what exactly is stop loss trailing then? Well, when you get into a trade, you should set a stop loss order on every trade. So for this is our entry, this is our target, and this is our stop loss. Now your stop loss is going to get you out of a trade if a trade goes bad. But the bonus of stop losses is, once we place them, we don't have to leave them exactly where they are. We can actually move the stop loss order different ways to different prices. Now we should never extend a stop loss, because if we get into a trade risking, for example, $1,000 on this stop loss, if we double the size of that stop loss, we're actually now risking $2,000. So it's impossible to manage risk if you extend your stop loss that way. But what we can actually do is grab our stop loss order. So let's say this is indicating the stop loss, and we can pull it in to the entry price, for example. Now, if we pulled the stop loss to the entry price and the market went up a little bit, but then reversed on us, rather than taking a loss if the market got down here, we would actually be closed out of the trade at this point, which means rather than losing money, we would just be out of the trade for break even, okay? Which means we do not take a loss and means essentially we've won this position in a sense that it didn't cost us money. Now, we can also move our stop loss into profit. Obviously, we can't do this if the market price is under where we would like to put the stop loss. But if a trade starts to move in our favor, we can actually utilize this ability to move stop losses by doing what we call trailing. So let's say this position moves in our favor up to this point, and then we start to create some new structure. What we could do in this instance would be move our stop loss up to follow the structure. So this way, if the market pulls back, finds a new low, and continues the trend, we can simply trail again. But if the market is to make a full-blown reversal and move all the way down here, rather than getting stopped out for a loss, which is not good, or break even and missing out on all of the profit potential we have in this area, we would actually be stopped out of our trade at this level here. Now, if we think about what that would do for us, well, our 5.5% potential trade would be stopped out here at 1.8%. Of course, we didn't get the full 5.5% that we wanted, but we've still taken a positive outcome on this trade, okay? Rather than making $0 or making minus 1%, we've actually made plus 1.8 because we trailed the stop. So stop loss trailing is simply utilizing the fact that we can move stop loss orders and following price with our stop loss as the market moves up. If we do this, we can actually minimize the possibility of this trade turning into a 0% trade or a losing trade. And we can maximize the profits that a trade can provide us because we can actually close it as soon as it starts flipping on us. Now, there is a right way and there is a wrong way to trail your stop. If the market is moving up in your favor, what you shouldn't do is just run your stop up immediately behind price, okay? So let's say price moved from here to here. You don't want to just follow it directly with your stop, because as we know, markets rarely ever move perfectly upwards or perfectly downwards. Most of the time, if we look at smaller price action or smaller charts, we're going to have some movements like this going on, right? Which is, of course, likely to lead us to being stopped out by market noise on the way up towards the target. So because markets are prone to moving up and down, and we could get movements like this before the target is hit, it's important that we're smart with our trailing. The best way to trail stops to avoid the problems we've just discussed is to follow structure, okay? So structure refers to highs and lows in a market. Now, if we take a look at this market example here, let's say we have our stop loss in its initial position, we can mark structure up from high and low perspective. So this is our high, here we have a low, here we have a lower high, and here we have a lower low. We have a lower high, and then we have the low, the lowest point, okay? So this phase of price action based on structure is bearish. That's a market that's moving down. In this instance, we would want to sell. The formation of the trade that we got happened after we had a break of structure here. So a break of structure is simply a point of which the structure breaks, the previous low, previous high breaks and gives way to new price action. So this would be our break of structure on the downside, as would this and as would this, where we're seeing the market price breaking consistently into new lows. Now I see this here as a break of structure into a new high. This is the start of an uptrend. You might know this as a change of character. For me, that's kind of pointless terminology. I don't use it, but that may be what you've heard of that if you've traded price action before and you're confused as to why I call that a break of structure. Now, the market at this point is trending up. How do we know that? Here we have a high. Then we create a higher low. So this low is higher than the previous one. Then we create a higher high, a higher low, higher high, higher low, and so on and so on. You get the idea, right? So what we're actually doing is looking at the real highs and lows inside of the price structure. And this is how we're formulating ideas as to which way the market's going. Now, how is this relevant to stop loss trailing? Well, that is because we are going to follow the highs and lows in price to actually decide where to put our stop loss. With this initial move up here, we're not going to do anything with this stop at this point because there's every possibility that after pushing up, the market pulls back down and then continues after making a new high just above this previous one. So because of that, we don't really want to move the stop based off of the first price movement. Then we see this point here, the market pulls back, creates a new low, and then pushes up and creates a new high. So this high here validates the structure, right? At this point, we have had a movement up, a validated low, and a new validated high. The high and the low is validated when we get the break of structure. Our break of structure in this instance took place at this level here. The point where this high was broken by price, creating this new high, which validates this higher low. At this point, we could actually trail the stop to under this structural low here. The reason we can do that is because if the market is then to reverse and take out this low, we could be seeing here a change in the trending structure of the market. We've actually then gone from a market phase of upward higher highs and higher lows, and we would be shifting back into a new lower low with a break of structure under the current price action of the uptrend. This is then likely to be followed by a pullback and sell, which would generally lead us to losing or breaking even on the position. So basically what we're doing here is waiting for validation of a trend in this format that we've just discussed. Then we can follow price by putting the stop loss under the recently formed higher low. As you can see then, after creating this high, the market pulls back and creates a new higher low. This higher low is not validated until we create this high. When the market creates a break of structure over the previous high, just here, the break of structure being here, this closure up here validates the initial low, the low being this one in this example. So at this point, we could then safely trail the stop loss from here under this structural low to here under this structural low, because we know that the higher highs and higher lows of the market continuing up and up and up, and with the formation of this high, we've validated the formation of this low, and the market shouldn't really move under this low if it's continuing in its uptrend. All right. Once again, then we come down, we form a low here. This low is validated when there is a break of structure here, creating this new high. So we can actually pull the stop up to this level and trail it under this low. Now, if the market had then created a high, validated the high, and we trailed the stop, and then decided to reverse on us, so if we'd have had a movement down like this, we'd be stopped out here instead of all the way down back at our entry or at our stop loss. This means we would have created a profitable trade here of 2.2%, which obviously, yes, is not the full percentage target we want, but it is still a lot better than the trade going all the way back to zero or to negative. So that's the idea behind stop loss trailing. Structure is the one big thing we want to look at.